Many people want to save up for a house, a retirement, but they don't know exactly where to start. Fox 5 financial expert Chase Wilsey joining us now with investing tips for the beginners out there. Chase, good morning.
Good morning.
Oh, those beginners. Everybody's got to start somewhere. You say start early. What's the best way
Yep.
to do that?
It's so important. Yeah, start early. Open an investment account, get going. Whether it's your 401k, just a brokerage account at one of the major custodians, Charles Schwab, TD Ameritrade, Fidelity, whatever it is. And if you didn't start early, well, start now. The reason for that is allow that compound interest to work for you. That's the idea that your earnings and your interest allows your money to work for you rather than you working for your money, of course. To provide an example, let's say you invest $20,000 at 8% for 40 years, that would give you $434,000. But if you cut that time frame down by 10 years and only invest for 30 years, same 20,000, same 8% return, you would have just $201,000. So let that time do you a favor and grow your money.
Wow. Okay, there's a difference you say that you have to know between saving and investing.
Yeah, and saving, it's a great first step. If you're taking that step to actually put money away, good for you. But you have to, again, realize that there's this thing called inflation, which eats into your investment returns. It's going to hurt your real net worth. Over the long term, that inflation's average 3%. So let's say you actually invest in a savings account, or not invest, but save in a savings account, and you're getting 1%, which is pretty generous at this time. For a 20-year period, $20,000, well, that would just grow to $24,000. But you invest in stocks over the long-term average close to 10%, that same $20,000 over 20 years at 10% would grow to over $134,000. So you need to take that additional step to invest, not just save.
I think people need to look into the future, have a little patience, and do a little math, and it goes a long way. You also say, don't time the market. What do you mean?
We hear this time and time again, and people get uneasy when stocks start moving up and down and up and down. It's because they look at them at gambling chips. You need to look at investing in stocks as small pieces of large companies. You have equity in that company. It's not just that ticker tape where the stock's moving up and down, up and down. And Peter Lynch, who's a famed investment manager from Fidelity, he actually said people have lost more money trying to time the corrections than actually weathering the corrections themselves. And I love this too, Raul. If you look at John Maynard Keynes, he's one of the most famed economists of all times. He tried to time the market based off credit cycles, investment psychology. Wasn't successful with it. He actually lost a ton of money, switched over to long-term investing, just buying small pieces of large companies. So don't jump in and out. You might get lucky once or twice, but investing is a long-term game.
It is indeed. Understand your investment philosophy.
This kind of helps ease the emotional side of investing. When you look at understanding why you're buying an investment, what you're doing, you're less likely to, again, make those silly decisions, make those emotional decisions. At our firm, we stick to what we call value investing, kind of like Warren Buffett, kind of like Benjamin Graham. And the reason we like this is, again, you're not going to try and time the market. Also means you're not always going to be right. You're going to miss out on the next Amazon, the next Tesla. But you're also going to avoid buying, the Qualcomms, the Intels of the world during the tech boom, where you could have lost 80, 90% of your portfolio.
Wow.
A very dangerous place to be. We'd, again, rather be right for the wrong reasons than wrong for the right reasons in our philosophy.
You mentioned the magic portfolio word because the other word that I always hear is diversification. You got to diversify your portfolio.
And what we're looking at here, as I kind of mentioned, with the tech boom and bust, people had so much money in tech companies. They lost 70, 80, 90% of those portfolios. We actually had a client that had $8 million worth of Qualcomm in her portfolio, refused to sell it because she did so well with it. Well, then Qualcomm fell from a share-adjusted price of over $80 a share to under 17.
Oh.
She lost a ton of money. So you need to make sure that you understand what you're investing in, and also make sure that you have some technology, have some financials, have some food companies. You need to diversify that portfolio so you're not all tied to one industry that could just fall off a cliff like we saw during the tech bust.
Okay, I got a challenge for you because the last question I was going to ask you is give some advice to people just getting started. But here's the challenge. Somebody sitting at home right now, what do? We're in the middle of this coronavirus pandemic. People are losing jobs, people are losing money. Is this a good time if you have a couple extra bucks stashed away? And what do you do? Like right now when we're done with this, what should they do?
Well, I have my crystal ball in the office here, but doesn't always work perfectly. But what I would recommend is, buy a company, into a good mutual fund, perhaps, depending on how much you have to invest. Look and understand what's going on with that business. We, again, stick to that value approach, so that's the approach I recommend. I will tell you, things are kind of expensive right now,
Yeah.
given how much we've run up over the last few months from that bottom. So don't feel the need to rush into things right now, but just be patient. Look for some good opportunities because they're still out there, but just understand what you own and don't make those emotional decisions. That's just what crushes the average investor in the long run.
All the emotions, got to keep those things in check. Chase Wilsey, we thank you as always. Great advice this morning.
Thank you. Thank you for having me.
All right.
Time now